Hello, ladies and gentlemen. Welcome to the second video of the Aerial FX Beginners course. For brand new traders, this can be very, very helpful for you. For more advanced or amateur traders, this can be more of a recap for you, but still is very important to recap and understand really the basics of what Forex is. So let's just jump right into it. What is Forex? The foreign exchange market, what we trade, and this is why you purchased our course to learn more about this. The market that you will be trading in later on, or if you already have been trading in it, the one you're trading in now. The most commonly known as Forex is an international market where the globe's currencies are exchanged. It's the largest and most liquid market in the world, and it accounts for over $6 trillion worth of transactions per day. Now think about that for a minute. That's absolutely huge. I think the stock market only does about 150 to 200 billion a day, but the Forex market does over $6 trillion a day worth of transactions. But what's even more crazy is the fact that most haven't even heard of the Forex market before. Most people haven't even heard of this market. Okay, everyone's heard of the stock market, the Dow Jones, the Nasdaq. Everyone's heard of that, but not many people have heard of the foreign exchange market. So now let's hop in to really how the Forex market works. These exchanges come in the form of buying and selling through fluctuating exchange rates. All right, and we'll discuss this in a little more detail in a little bit. Currencies are important to most people, whether they realize it or not, because currencies are exchanged in order to conduct foreign trade and business. So let's say you go on vacation to France, you will need to exchange your currency for euros, which is a local currency in France. All right. This will allow you to buy the goods and services in France that you wish to purchase. The same kind of goes for business transactions as well. Coca-Cola, located in the United States, headquarters in Atlanta, that does business in Tokyo, will need to exchange their revenue made in Tokyo from the local currency of the Japanese yen back to the US dollar. This is what causes these exchange rates because one currency is demanded over the other. All right, currencies are constantly exchanged, which causes these slight fluctuations in exchange rates. So what determines the actual exchange rate? Well, this is all based off of supply and demand, which you'll learn more about later in the course. But an easy example of this maybe, let's say you go to some country in Europe, let's just say France, for example, that's what we used before. And you take 1,000 US dollars and you exchange those 1,000 US dollars for euros because that's the local currency in France. And you may get, 910, 915 euros depending on the current exchange rate. And, you go to Europe, go to France, you have a great time. You come back and you don't use any of that money. You don't spend any money, let's say, and you come back and you come back to the lady at the desk and you exchange your money, your euros back to US dollars. And let's say she gives you 1,010 US dollars. But you think to yourself, well, I only started off with 1,000 US dollars and I didn't spend any money, but I'm receiving 1,010. Well, that doesn't make any sense. Well, actually, it does make sense because the exchange rate while you were there differed or fluctuated in that time. And to go into more detail, the US dollar weakened over the European dollar. So this is how we trade Euro USD. All right, that's a currency pair, and we'll go over those in a little bit. Euro USD, the US dollar weakened over the euro. All right, so the euro gained strength, giving it more purchasing power, more buying power. So it costs more US dollars to purchase euros, but you have euros, so now you're going to get back more US dollars because it strengthened the euro while you were there. The currency exchange rate fluctuated. All right. So how are these currencies traded? As in who actually facilitates the transactions and drives the markets? Well, this comes with big institutional banks. These are the key players that drive the market and push actual prices up and down. They are the liquidity providers in the market, which allows for such massive transactions and fluctuations in the exchange rates. Now, did you know that you and I aren't really the ones moving the market, but we're the ones actually placing all the trades, right? This is a lot of the questions that I get a lot. We're the retail traders, we're the ones who are placing the trades, but why aren't we seeing such movement in the market? So what comes when such influx and volatility and the markets move so fast? Well, this is because of the institutional side of the market. All right, so the big institutional banks, I said, they're the key players in the market, and they're actually moving price and allows for such fluctuations in exchange rates. You and I, we're trading pennies on the dollar compared to large banks, such as Citibanks, Goldman Sachs, Deutsche Bank, just to name a few. These institutions, the reason why they're actually moving the market is because they're trading with hundreds of billions of dollars. They're actually manipulating price and influencing the exchange rates of these currency pairs. This allows them to manipulate price, stop out a lot of retail traders, and we're going to get into the ways that they do this, kind of later on in this course and more in detail, in depth in the advanced course. So you and we're just considered retail traders. We place trades on our own accounts. Banks and institutions are considered institutional traders, hence their name, because they trade for the accounts they manage for a group or institution. Kind of simple as that. Basically in layman's terms, we are the small fish in a sea of sharks. Really, that's what it is. That's how I like to put it. But we can still make money. We have to trade in the retail market using brokers as our source of capital. And I'll explain why we have to do that in a little bit. Once we place a trade, the broker is notified and places the same trade in the real market called the interbank market. If we lose, obviously the broker takes our money, but if we win, we are credited that amount of the win to our trading account. All right, so now let's hop into the different currency pairs, and I'll kind of go into the exchange rates that make up them as well. That make up the foreign exchange market, the sessions these pairs are traded in, and what times of the day they are traded the most. All right, so there are three main sessions traded in the foreign exchange market. One is London session. So let's just type this in so you guys can have a little visual and you can write this down and take notes if you guys don't already know this. But it is important for a recap if you already do. So the London session, this is where, let's say Citibank, they have many locations throughout the world so they can trade around the clock, right? So they may have a location in London, and then obviously they're going to have one in New York as New York session, and then Asian session, so in Asia somewhere. So let's focus on London session. So the London session traders, they're going to come into work, and this is going to happen between 3 a.m. and 12 p.m. Eastern Standard Time. So this happens around 8 a.m. GMT. This is when everyone gets to work. This is when the normal workday starts for them, right? But since I am in Eastern Standard Time, I'm going to use Eastern Standard Time for this example. Wherever you are in the world, adjust that according to your time, all right? And most of these pairs, all right, that are traded during these times, or most of the currencies are going to be the pound, the Great British Pound, all right, the Swiss franc, and the euro. So why just those three? Why not other pairs? Well, these are the European currencies, so they're going to be traded the most because business is high during those days. All right, so people are constantly purchasing, buying goods and services, exchanging currencies, one currency for another in Europe. So they constantly are moving, exchanging exchange rates. So it's constant volatility in either direction. So that's what's going to experience the most volatility during London session is going to be through the pound, the Swiss franc, and the euro. So now the New York session. All right, so the New York session occurs between 8 a.m. and 5 p.m. And this is really where you get, your 9 to 5 workers, right? But really it's 8 a.m. to 5 p.m. So your 9 to 5s or your 8 a.m. to 5 p.m. This is where most of the New York session currencies, and this is going to be the U.S. dollar and the Canadian dollar. Let's make this clear for you guys. There you go. All right, so U.S. dollar, Canadian dollar. And obviously, the U.S. dollar and the Canadian dollar are going to be traded the most because this is when the U.S., the United States, has the most business transactions is during these times of the day, 8 a.m. and 5 p.m., the workday. The last session we're going to go over is the Asian session. And for me, the Asian session is going to occur between 7 p.m. and 4 a.m. Eastern Standard Time. All right, let's put this in here so you guys can have that, Eastern Standard. All right, these pairs that are traded the most during these sessions are going to be the Japanese yen, the Australian dollar, so you can expect between that, and the New Zealand dollar. Again, because all these currencies are exchanged the most during the session because this is when the business day happens. They have to exchange currencies and buy goods and services, which affects the exchange rates. All right, so now that you understand the different sessions and the pairs that are traded in, well, what are the best times to trade? Why don't you want to trade the US dollar in London session? Why don't you want to trade the Australian dollar in New York session? Well, like I said before, the Australian dollar, most of the business that occurs in Australia are not going to occur during the times between 8 a.m. and 5 p.m. They're going to occur between 7 p.m. and 4 a.m. But now let's say you cross a pair like AUD USD, like we have up here, AUD USD, that's a currency pair. Then you could trade this in New York session because it has USD in it. Now let's say it's like GBP, Great British Pound, Japanese Yen. You can trade this GBP JPY in either London or Asian, just as AUD USD can be traded in Asian and New York. So you kind of have to pair up these currencies and trade them in the correct sessions. You don't want to be trading NZD USD in London session. It's not going to experience much volatility at all. All right, and it could have some false moves and potentially stop you out. All right, so now let's get into kind of how the exchange rate works and why you need brokers. Okay, brokers are going to be very important in this industry because it's going to allow you to actually make profit. All right, so for instance, AUD JPY, it takes, and this is how you read it, it takes 71.48 at the moment, 71.48 Japanese yen to buy one Australian dollar. It takes 1.2296, or now 1.2298 US dollars to purchase one Great British Pound. It takes 1.1090 US dollars to purchase one European dollar. It takes 112.06 Japanese yen to produce or to buy one Swiss franc. All right, so that's how it works. But you can see that. Let's just go for Euro USD for instance, 1.1092. Obviously, that's the dollar. That's the tenth, or that's the dime, and this is the penny. So 1.10, the zero is the penny. This is going to be the tenth of a penny, a hundredth of a penny, a thousandth of a penny. Okay, and we'll tell you how to actually calculate what's called a pip, which is pip is basically the measurement of the exchange rate and how it fluctuates, and we'll get into that on the next video. But you can read this as 1.1093, the tenth of a penny, the hundredth, the thousandth, the thousandths. So you can see that it's currently fluctuating the thousandths of a penny, and now a little bit of the hundredth of a penny. Maybe by the end of the day, it could reach all the way up to the tenth of a penny, which is going to be about 100, 200, 300 pips, depending on where it moves. All right. So why do you need brokers? Well, brokers are going to be very good sources of capital because they allow you to use hundreds of thousands of dollars, maybe even millions of dollars, depending on how much you have in your account, to trade in to trade these pairs to actually produce a profit. Because if, let's say you traded $100 of your own money, you used $100, and you traded Euro USD, and it went from 1.1094 to 1.1095, you're only making a 100th of a penny. All right, so you're not making much at all. This is why you need hundreds of thousands of dollars to put in. So when the exchange rate only differs by a hundredth of a penny, or a thousandth of a penny, or maybe even a tenth of a penny, you're able to rack in a lot of profit because of that. That's why you need brokers. Allows yourself to use the capital that they give, and then you have to give them a fee for every transaction that you place in the market. All right, so hopefully this was just a little recap for maybe the more advanced traders or the amateurs out there. But for the beginners, this is very important stuff. Okay, all right. So you don't really need to know that. It's actually very important to know that 71.5 Japanese yen is used to buy one Australian dollar, but because price is definitely important. But what you really need to understand is the technicals behind it, and that's what we're going to go over in the later videos. So I hope you enjoyed this video. I hope this was quite informative. Keep this in your notes. It's going to be very important. All right, understanding really what Forex is, and the different sessions that occur throughout the world and throughout the day, and the currencies you should be looking to trade during these sessions. Okay, and we're going to go through how London session 3 a.m. to 12 p.m. Well, New York session 8 a.m. to 5 p.m. That's during London as well. There's going to be session overlaps, and there's going to be tricks and keys in order to trade during session overlaps to produce the most amount of money, because there are certain strategies and certain things you have to look for in your charts to be able to potentially make quite a bit of profit during these times, especially during overlap. And we'll go over this in more detail in the later videos, but hope you enjoyed this video. Make sure you're taking notes throughout this course, and we'll see you in the next video. Thanks, guys.